All right, I want to thank you again for joining us for our quarterly economic update. My name is Lindsey McKay, and today we are joined by Rachel Crane, who's one of our portfolio managers, who's going to give us insights from the perspective of Rockdale, what their outlook is, and just sort of some ideas of what's happening from an economic standpoint, a global standpoint, and then how they're looking about that or how they're looking to position clients' portfolios in light of all of that. So, as I mentioned, you'll all be in a listen-only mode. So if you have questions, please put them in the Q&A box that's in the bottom middle of your screen, and we will do our best to address them. And with that, I'm going to turn things over to Rachel, as I know she's got a lot to talk about today.
Wonderful. Thank you. And Lindsay, thank you for having me and the team at McKay Wealth Management. It's always a pleasure to speak to this audience. Uh, I only am going to be doing this now when the market's up and government shutdowns seem to be on the end so that everybody's in a good mood. I can't see any of you, but I'm hoping you're all in a good mood today, like I am. But a lot to unpack in terms of what's going on in the world. And I want to start here with our economic and financial indicators, as I often do for those of you who have heard me speak in the past. These are what we would think of as our roadmap. Over the next 6 to 9 months, where do we think there are areas of strengthening in the economy, areas that are neutral, indicated by the yellow, or areas where there's headwind or slowdown in the red? What you can see is actually a pretty good mix of green, yellow, and a couple of reds. I'm going to address kind of the big picture first, which is that we've been in an economy that has been growing positively. It's been growing despite the fact that interest rates were elevated 11 times in 2022. As you might remember, in 2022, inflation peaked at 9%, and the Federal Reserve said, oh, I guess this is not transitory. We need to start combating inflation by raising interest rates. And when they do that, they raise rates to a point that it slows the economy and therefore slows inflation. And that has really been the story until this summer. The story of combating inflation, higher rates, higher rates. Well, it changed slightly in the summer. The Federal Reserve met in Jackson Hole, as they always do annually, and their commentary shifted from inflation to the labor market. So the Federal Reserve has two mandates. One is to have a healthy labor market, and the second is to have manageable inflation around a 2.5% target. Those are their two mandates. Now, I'm assuming someone has a question out there about whether or not they're independent. We'll get to that in a minute. But with that mandate, they really were attacking inflation and with higher rates, with those 11 interest rate hikes. And the reason why I'm harping on this so much is because the most important thing happening in the economy right now is interest rates. Now, I know that that might sound a little surprising when you turn on the news and you hear about tariffs and a government shutdown and immigration or geopolitical conflict. All of that also matters. But interest rates and combating inflation has been keeping the economy from growing robustly since 2022. That has been intentional. Since the summer, where the Federal Reserve started changing their tune, where they feel more comfortable with where inflation is at today, they have now cut interest rates twice this year. The question is, are they going to continue on their interest rate cutting path? But between now and the end of the year, maybe another cut, that's questionable. And then what is the expectation for 2026? But we have a green indicator here on monetary policy and interest rates and yield curve, because what the rates are indicating and what the yield curve is indicating is that there's less pressure on inflation at this point, less pressure on the economy from higher rates. There's nothing the market likes more than low interest rates. Why? Because profitability can increase, because there's more opportunity for investment. This doesn't necessarily translate to low rates, but less high. And when we think about where we're headed, the headwind of interest rates being elevated, it worked. It worked from an inflationary perspective. The question is now, how long do we have to keep interest rates elevated before getting to a neutral interest rate? This is all in balance with the labor market. If the labor market is healthy, which it is, though there has been some recent softness in the labor market and some data that was um, it sizably changed this year. The if consumers are working, they're spending. All of this drives towards our center dial here of consumer spending. Consumer spending is 70% of US GDP. And I don't know about you guys, but if you've been out and about lately, the one thing I see is that consumers are spending. Restaurants are full, airports are full. This week, maybe a little bit different, but airports are full. Sporting events are sold out. Concerts are sold out. Consumers are spending money. When I say this, sometimes investors will say, and clients will say, but only the wealthy are spending. Or what about the lower income brackets of the economy? They are stretched, and inflation has impacted them the most. Now, we don't disagree with that. We're certainly seeing that in the lower income brackets that that they are working and so they have income, but that income isn't going as far. On a broad-based economy, it hasn't impacted the total dollar spent at this point. And so because of that, consumer spending is still in this yellow category, not red. Consumers haven't pulled back spending broadly. But there is a valid question, if anyone of you had that on your mind, that the K-like recovery or the disparity of wealth, the haves versus the have-nots, are feeling this economy very differently. Moving on to that, when we think about these two red indicators, I want to start first with geopolitical risk. For those of you who have seen these in the past, you know that geopolitical risk is almost always red. And it's not to suggest that the environment we're in now is in worse of a geopolitical uncertainty or better. There's arguments both sides for that. But that in general, geopolitical risk is ever present and can create a change to economic growth, typically negatively, if we were to get some kind of geopolitical shock or surprise. The equity market valuation, though, is one that is red. I'll talk about it in a little bit more detail. But this speaks to stock prices and the market. There was a Wall Street Journal article this morning that said, if you're feeling good about this economy, it must be because you own stocks. I don't know if any of you saw that. But the market keeps going up and up. It's bouncing around a little bit, but it's had a really positive year. But sentiment is not amazing. Let's call it neutral, but neutral to negative sentiment. And this disparity between market returns and portfolio returns and sentiment is creating a concern for a lot of investors that we're about to go into a sizable downturn. Are we going to see the other shoe drop? Is the bubble going to burst? And frankly, the short answer is we don't think so. In fact, when we look forward into next year, our estimates are that we expect the economy to continue to grow very similarly to how it's grown this year. This is a busy slide, but we're looking at 24, 25, and 26. And when we look at the GDP growth, this year we expect it to come in the mid 1%. Consensus is actually closer to 2%. And next year, about the same. Now, this is not the kind of economy that's booming, but it's not recessionary. It's not an indication that we're about to see a sizable downturn or contraction. And where there's a really bright spot is actually in corporate profits. Earnings reports, as companies have been reporting quarterly, they continue to outpace estimates. Over 80% of companies beat estimations this quarter and last quarter. We're actually on the fourth quarter of double-digit corporate profit growth. Now, a lot of that is driven by AI enthusiasm and tech companies, which we'll talk through. But even broadly, more broadly across the market, we're seeing good corporate profit growth. The combination of positive economic growth plus positive corporate profits, in our view, means that we can have another good year in 2026. I would suggest, though, that we didn't anticipate the market to be up as much as it has been this year. We were expecting more of a 7 to 9% type S&P 500 return, not a 14 to 17% type return. Again, a lot of AI enthusiasm, interest rate cuts, continued consumer spending has been driving this forward. Continuing on the Federal Reserve commentary, I do want to highlight we do think rates will continue to come down, but not to a stimulative zone. Stimulative being beneath that 2.5% rate would be where the Federal Reserve is intentionally cutting rates to stimulate the economy. And we think they're going to stick around that neutral interest rate in the 2026 to 2027 type area. When we are thinking about what's going on in the news, so there's a lot of topics in the news right now. We had these slides created, and today we've got some better news about the government shutdown. But just to spend a minute on this, what is the impact of a government shutdown? Well, broadly, what's the impact of the political environment in general? Historically, it would be seen that the market often ignores what's happening in the political environment. And that's because a lot of times policy doesn't translate to profits. There's a lot of policy that voters are very passionate about and are very important to the social structure of the United States, the environment, the other issues, right, that we live with. But what the market cares about is, does this policy impact how much Walmart is going to make in corporate profits? And so the market does care about tariffs. We'll talk a little bit about that. But the shutdown typically is a non-event for the market. And this year we got a little bit of volatility around the government shutdown, and today stocks are up a little bit because of the likelihood that we're wrapping this up. I was joking with some friends earlier. I was like, you know how you get Congress to act? Shut down flights right before Thanksgiving. We cannot have a Thanksgiving, an economic burden of Thanksgiving with no flights. So I'm not surprised that really pushed some action, and hopefully it all gets resolved in a very near term so that the economic data doesn't have any sizable impact. But at this point, it's very likely that this will be a non-event for the economy and the markets, assuming that we get to the other side of this in the near term. Tariffs are really something that's continuing to drive questions. I see a question came in here about what happens to the markets and the economy if the Supreme Court strikes down Trump's tariffs. Tariffs are really, and I'll actually just jump to this, and we're in this discussion already. But tariffs have been really a challenge for two reasons. One, it's been a challenge for the economy for the markets to anticipate. So of the tariffs that have been discussed, how many will be imposed, for how long, and how does it impact corporate profitability? A key thing to remember about our economy is that we are 1/3 goods and 2/3 services. So 1/3 goods, 2/3 services. The tariffs are going to impact the goods portion of the economy. Now, is that going to trickle down to other sectors? That likely would be the case. That's why back in April, when we had that Liberation Day announcement where Trump said we're going to put tariffs on every country, on every good, the market really didn't know what to do. We saw a sizable decline in one day, down 10%, up 10%. They're trying to digest, are tariffs going to put the economy into a recession? The short answer at this point is that it doesn't look like it. That the tariffs are a higher cost, and there are areas where there's going to be pain points around that higher cost. But we don't see, since that Liberation Day announcement and following negotiations, that it's going to derail the economy, and the market is not pricing that in. That being said, the question is, well, what if the Supreme Court determined that tariffs are not legal? Well, the market probably would react positively to that because that would indicate, okay, we're not going to have this higher cost. Corporate profits are likely going to be able to make up, what they otherwise would be impacted by in tariffs. We think in the short run, it would be a net positive to the market. In the longer run, it would increase the deficit because some of what has been done already has been an assumption that we're going to see revenues from tariffs. And so short term, positive, longer term, more negative as it relates to the deficit. So just wanted to go back to this as we look at corporate profit growth and consumer spending and inflation, because we're always tying back these questions about policy. Do they impact those specific data points? And if so, the market reacts negatively if it's going to be an increased cost and ignores it if it's not. Another thing that's been coming up regularly in some of the news and the items that I'm talking to clients about is just geopolitical developments. And since Liberation Day to today, it seems that the tariffs and the concerns about geopolitical relations have sort of been targeting into China. And there are a lot of arguments on both sides about whether or not these tariffs should be imposed on China, what makes sense. But what has happened in the meantime is that agriculture products have taken a hit. China is one of the biggest buyers of soybeans and cotton. In fact, a few weeks ago, I was in Lubbock, Texas with some clients, and that's what we were talking about, soybeans and cotton prices. China's purchasing of these goods and how it does have an impact on different segments of the market. So the point is to say that that the imports and goods from China matter, right? And you can see here the change that we've seen in this chart, the sizable decline in the import of goods from China, and how important that is as we think about economic growth. The takeaway is that there are specific goods that we import that tariffs are being imposed upon. The question is how companies are able to adapt. And one important piece of data on this is that in 2020, China was our largest trading partner. In fact, we imported goods from China as our number one trading partner. But after the COVID-19 shutdowns, because China closed down so dramatically and so harshly, companies already have been adapting away from China. And since then, companies have taken a different approach, which is to diversify their suppliers. And so are the companies we're invested in companies that can adapt? That is going to be the measure of the outcome of tariffs in terms of corporate profitability and the translation of that to the end consumer. Where there are some social consequences of this, it is more often than not the largest companies that have the most power with suppliers. Smaller companies have less control. And so when we think about the local mom and pop shop, they have less negotiating power than, say, Home Depot or Walmart. Walmart has the ability to say, well, you're going to pay the tariff, or, we're not going to accept the tariff, that kind of thing with their suppliers. So when we think about where we're going from here, tariffs are still yet to be seen how this plays out in terms of economic growth. But it also created another sort of challenging look through for the Federal Reserve, because again, as they were navigating an inflationary environment and pushing to get inflation down, as the tariffs were announced, it became difficult for them to look through to say, are these tariffs going to keep inflation elevated? Now, I want to make one comment on inflation, which is important. Whenever I'm talking about inflation, I'm talking about a year-over-year inflation rate. And so you'll hear me say inflation is coming down or inflation is more under control. What that means is the rate of prices going up is a more reasonable rate. It's about 3% now, as opposed to the 9% peak of 2022. The that is not the same as deflation. I'm saying inflation's coming down. I don't mean prices are coming down. And anecdotally, we all know how much the cost of items, insurance and homes and food and, what we spend a lot of money on has gone up in the last 5 years. We're not suggesting those prices are going back down. But what the Federal Reserve is trying to do is to keep them spiking in that high inflationary environment year over year. Now, this is a busy chart, but the Federal Reserve has been signaling patience. Let's be patient. Let's see how this all plays out. So another answer to that Supreme Court question about tariffs is what happens if tariffs don't are not ruled as legal or ruled as illegal, and so they don't get imposed. Well, then that's even more room to expect that inflation could be less sticky, and the Federal Reserve could have room to cut rates further. So again, in the short run, the market would like that. In the last Fed meeting, the Federal Reserve was talking about don't assume, our next meeting in December that we're going to cut rates again. It's not guaranteed. We're going to wait and see. With a government shutdown, one thing that becomes challenging also is a delay in data. And the Federal Reserve wants to be very data dependent. And they are trying to set a very clear message that they are independent from the administration, that they are data dependent, and that they are going to take action to cut interest rates or maintain interest rates based on their mandates around the labor market and inflation, not due to pressure by the administration or any other reason. Another question that comes up here, though, is well, when Fed Chair Jerome Powell's term finishes and a new Fed chair is appointed, is it going to be very different? And I mean, the question is a good one because everything we've seen, the answer we're going to have to wait and see, but I think it's a very low probability. It's a low probability that the Federal Reserve is going to go off and do something that's not data dependent and independent. Because what they are managing here is a complex economy where they are focused on keeping the right rate of inflation. If they cut interest rates too low too soon, then they lock in a long-term inflationary problem. So what this chart is trying to say here is the sentiment of the Federal Reserve members, what is the bound of where we think rates are going to be. This chart is very funny because it's kind of hard to read, but the dovish or hawkish, dovish meaning more cautious, let's keep interest rates high. Hawkish meaning let's cut rates, the economy's growing, and more positive on that. What's likely here is that we're not going to see sizable changes in rates. I had mentioned the 2022 11 interest rate hikes. You see that in the chart. And now we got 4 interest rate hikes and there was a stall. We've now had 2 interest rate hikes. We had 4 interest rate cuts in 2024. And then through 2025, we were waiting and waiting. And then we just recently got those 2 cuts. Are we going to get another one this year? This neutral interest rate, as I mentioned, we're likely not going to see in the near term. They can still cut rates without stimulating the economy. The credibility does seem to be rebuilding, and that I think is positive for the economy and consumers and business owners. Now, we've talked a lot about inflation because inflation has been the story. Inflation led to those 11 interest rate hikes, which led to the slowing of the economy. But the other side of the coin, which is really important, is the labor market. And a lot of what we're dealing with in the labor market goes back to a COVID time period. If you remember in 2020 and 2021, we closed down the supply chain. We sent everybody home. People retired early. They got laid off. There was a massive shift in the labor market. And the labor market got very tight. There were about 2 job openings for every 1 person looking for a job. And that is a very disjointed labor market. And so there was so much demand for labor that wages had to go up to attract labor to come in. And where did we see the biggest wage increases? In the service industry. Here in San Francisco, very difficult to entice people to commute an hour to come work at a restaurant if they were still open, or at any kind of service, hospital, obviously, medical or schooling. Um, and so the cost of labor went up, and that also contributed to inflation. And so we've been dealing with a very tight labor market, and it's been loosening up as people have come back to the workforce, and then as there have been fewer jobs created. Um, what's happening now is some cooling of the labor market data. There's been a mind shift. Back in 2020, companies were not willing to lay people off because they didn't believe that the ones who did got burned because they actually needed all that labor. If you think about Southwest Airlines or Alaska Airlines, they laid all of these pilots off or let them retire early packages. And then the demand was so strong still and came back so quickly, they couldn't hire quickly enough to meet the demand. And so they lost market share. So now companies are less inclined to lay people off. That's what has gotten softer. Companies now have shifted. They're seeing more of a talent pool out there and are willing to lay people off. That being said, though, it hasn't been a broad change in unemployment data, but we have seen this job growth has slowed. Uh, and that is starting to signal the Federal Reserve that potentially the economy is slowing. And if we have this continued uncertainty around tariffs, government shutdown, businesses become more conservative. And it's wait and see type environment. And so if I'm a business owner today, I may not be anxious to go out and hire people if I don't know what demand is going to be. And so uncertainty on its own can create some slowing of the economy. But if the economy is naturally going to be slowing because of uncertainty, we still don't need those higher rates. We need rates to come down to neutral so that high rates plus uncertainty don't lead us into a negative GDP environment. So that's what the Federal Reserve is balancing. This year, there was a sizable news around the jobs data revisions. And the way the jobs data is collected is they're mailed surveys to business owners, and then the government gets those back. They count up the job openings, and then they get revised. And this year we had the largest revision in history. And so there's kind of two comments on that. One is, well, maybe we need better data collecting tools. That's probably fair. But the second is, how reliable is data if we see about 1 million jobs revised downward? The Federal Reserve is trying to make decisions based on this data. They know that there's some amount of incorrectness, which is okay. They'd rather have some incorrectness for speed, because you could get all of the correct data, but it might take a year to get it. And by that point, it's not useful. So there's a balance there of correct data versus speed. So there's always some revision going on. But these sizable revisions then created this broader uncertainty of, is this sending a message that the economy is not doing nearly as well? Um, but what you can see here from the charts is some slowing in cooling in the labor market, but not collapsing, not recessionary. And that goes back to our 1 to 2% kind of GDP. It's going to be like landing a plane: positive news, negative news, positive news, negative news. And it doesn't mean we're crashing when we see negative data, because on the other hand, we have positive news to offset it. For example, interest rate cuts are a positive. Now, I do want to speak to this because of your area and my area as well. We are seeing more of an impact in the technology sector. And pretty wild chart here about what happened pre-COVID trends. And the scenario that we're looking at is, there's a change happening also in the labor market that has everything to do with AI, AI enthusiasm, and AI spending. So the tech industry, the tech sector, and I think we've all been seeing this for a while, Amazon and Microsoft here in San Francisco, and Google and Apple, that tech companies have been reallocating their investments. They've been spending a lot of money on AI infrastructure and building out, but they've been leaving behind other projects. And so some high-paying tech employees have been impacted by that. There's also been efficiency gains that have been being used that are impacting the labor market. I'd say the two biggest concerns people have about AI that I've heard is one, what is the impact of the labor market? What percentage of jobs are going to be available still going forward? And the second is how are we going to be able to tell what's real versus what's not real? I have no answers for that one. But in terms of the labor market, we are seeing since the launch of ChatGPT, the changes in by industry, what's happening to the employment market. And tech employment is well below the pre-COVID trends. So this is where maybe those of us anecdotally on this call feel like the labor market is even worse because of our location, if you have a lot of tech sector exposure to family and friends or just the news. But despite potential layoffs, the productivity improvements and the realignments that we think are in line are probably not large enough to threaten the overall labor environment. We're going to be watching this closely, but it is very interesting as you look at this. So the weekly average user of ChatGPT by industry, I guess we could use Gemini if some of you are more loyal to Google, but probably not in the Pacific Northwest. But where it's being used and where it's being used most frequently, if we think about professional services, like note taking as an example, an AI note taker, many of you have seen that, or in information technology, it's getting picked up more in manufacturing, but you can see in a lot of other industries, it's still not as much of a use. Now, I want to talk a couple more things about the market and then spend some time on question and answer. Because as I talk about AI, one of the things that's really important is that red indicator I showed you, the equity market valuation. So stocks relative to history are not cheap. They're not on sale. And the S&P 500 is a weighted market cap index. So the larger the company, the larger the weight you are in the S&P 500. And that's what this chart is showing. And so the top 10 companies in the S&P 500, not surprising, NVIDIA, Google, Microsoft, Broadcom, Palantir, Amazon, Apple, JP Morgan, AMD, GE. These handful of companies now account for almost 39, oh, too much highlight, sorry about that, almost 39% of the S&P 500, and the Big 10, which include Amazon and Microsoft, Facebook, Netflix, Apple, Google, NVIDIA, Broadcom, Oracle, and AMD. This weight means that as their returns are positive or negative, they're going to sizably impact the return of the S&P 500. In these kind of periods, what can happen is more volatility. And investors today, some are chasing these returns. And they've been very, very strong returns in 23 and 24 and so far in 25. We can't forget, actually, though, in 22, we saw 30 to 40% declines in the NASDAQ. So these companies are more volatile, they are more expensive, and so they contribute more to market volatility. Now, we don't think that they're going to zero. We don't think that this is a 2000 and 1999 that these companies are going out of business. They have so much cash on the sidelines. They have very strong earnings. But they are being flooded with investment and it's pushing their stock price up. And so one of the risks in the market today is the fact that we have this imbalance in the market. And so we would expect that there's going to be volatility, not a bubble burst. I want to kind of reiterate that, But as these companies, if they continue to do well, which we do expect them to do well, that's going to help pull the market up. But if there's some sort of surprise or shock to the market, we have built in here a sizable amount of volatility exposure. So in April of this year, when we saw the market bouncing all over the place, what got hit the hardest? These Big 10. What were more stable? Bonds did very well. Consumer staples or those high dividend paying stocks in the industries that are more protective. So what I would suggest that this means about the market going forward is to be careful. Obviously you're all in great hands with the McKay team, that your portfolios are well diversified and you are not taking more risk than your financial plan requires. But there has been an attitude of chasing return that has paid off for sure, but we just need to be careful here that the portion of the market that's in a small handful of companies can certainly create more volatility going forward. But before I go to question and answer, I just want to stop here again and to just reiterate that we see signs of economic growth. There's uncertainty when you turn on the news around the political environment. That noise has not really trickled through the economy or the markets. Could it? Will it? Potentially, but probably on the margins. That as long as the labor market stays healthy and interest rates come down and consumers continue to spend money, the economy is likely to move forward in a positive direction. The AI enthusiasm, that bulldozer that's pushing the market up, just want to be careful to not be overly concentrated there as you're always looking at your risk and your financial plan as our red indicator of equity market valuation. But we still think it's a good time to be invested. We think there are very good spots of optimism out there. And so despite the uncertainty, we still think that this is an economy that can continue to grow with positive market returns. So with that, Lindsey, I'll turn it over to you for any Q&A or anything I may have missed that you think would be beneficial for your audience.
Yeah, well, Rachel, one of the things you and I talk about is just this, the psychology of feeling the need to take action. And so I'm having a lot more conversations with clients where they're saying, should I be moving into cash? Should I be adjusting my portfolio? Should I, should I, should I? And so we talk a lot about the timeline of when we need the money being a big driver. So long term versus, near term, and obviously space in between. But let's talk a little bit more about just diversification and how there is sort of a lot of movements that are happening in most of our clients' portfolios without them realizing as managers are making adjustments for this kind of 2026, the looking forward piece.
Absolutely. And there's some really important points there. And one point is that there's a certain amount of market volatility that is normal. There is an exchange that we are all making for positive returns. And that exchange is we are willing to tolerate downside and uncertainty for the reward of upside and long-term growth. And when we look at history, what we see is that the market has always recovered and continued to go up. And so market volatility doesn't hurt investors. That's a weird thing to say, but I'll say it again. Market volatility doesn't hurt investors. It's market volatility, or when the market's down, that when investors panic and sell, that is the biggest detriment to clients and investors gaining the reward on the other side. Now, you have to make sure you're not taking too much risk in the first place, though. And so having a solid financial plan in place means that you're not exposed to taking too much risk, the market going down, and maybe you're not panicked. Maybe you're totally fine, but you need to pay for your life for the next year, and you have to take your regular withdrawals out of the portfolio, and the portfolio wasn't built for that. This is where people get hurt the most. You are all solidly in good hands with Lindsey and the team. But behind the scenes, you also need management of the portfolio that is identifying where are those higher risk sectors and how do you invest around that. Now, this says CNR equity sector views. This is broadly, I think, just a framework that you could assume for any money manager that is being used is there are sectors that were overweight versus underweight. How do you find defensive sectors, so stocks and companies and bonds in sectors that we think are have good valuations, they're not overvalued, can support and support their dividends through uncertain times, and where there's opportunity. So as an example, one area of opportunity that we think right now is energy, because the valuations are very inexpensive. We think that the regulatory environment with this administration benefits energy companies. So that's an example of something we might add to a client portfolio, separate than a client discussion, but that we're just doing behind the scenes. Consumer staples. No matter what's happening with AI and uncertainty in technology, I still need to buy toothpaste. I still need to buy toilet paper and food products. So consumer staples are areas of defensiveness. When you think about utilities, utilities have been big performers recently. We're now moving to underweight utilities because they've had such strong performance, but we need energy. We need energy to support all these data centers. Is there enough energy to support data centers? So money managers are always behind the scenes, maybe without your knowledge, without it, if you're not seeing it, making these adjustments to different sectors within your equity exposure to make sure that we're not taking outsized risk, even in an environment where you might see some overvaluation.
Thanks, Rachel. I think that it's challenging because the past couple of years have been so positive that our kind of recency bias makes us feel a little bit more comfortable or
Mhm.
think that we feel a little bit more comfortable with risk. And then when the risk hits, we sort of have a reactionary moment. And so I love that point of just making sure that we're not going too much risk when times feel good and then overreacting and trying to really reduce that risk too aggressively when we start to hit periods of volatility.
Absolutely. And Lindsay and I talk about this a lot, actually. In 2008 to about 2013, 14, what a lot of investors were saying at that time is, I just don't want to lose the money. Could protect. There was a lot of focus on protection because investors had gone through the tech bubble and burst in early 2000, came up for air a little bit, and then got slammed again in 2008. And now that feels like a distant, very distant memory. But there were years there where investors were very focused on downside protection. That has changed. Now the mode is this fear of missing out on the upside. And that's not all bad. I mean, part of it is that costs have gone up. It's even expected maybe that people feel like they need more returns to keep up with inflation. But as sentiment shifts like that, you have to be careful, not, in the mass, and careful that investors don't chase a return because we all feel comfortable that the market only goes up. We're also thinking about that decade, 2000 to 2010, where the S&P 500 had a 0% return over a 10-year period. Many investors are too young to have remembered that, or they didn't have much money at the time. And so this is a dynamic that we're facing today is how to take the appropriate amount of risk to keep up with inflation and to grow portfolios, but not to chase a return that can hurt you later.
Yeah, and seeing the names that are on this list, I most of them are old enough to remember when that did happen. And so I think
You guys all
we
know.
probably skew a little bit of the, I don't want to repeat that. And so, there is this idea of how do we balance appropriately that risk and protection dynamic. So if anyone on the call wants to revisit how their accounts are allocated, I think most of them have a good idea, but happy to revisit that with you as we finish out 2025 and really start to think about 2026 and what might be on the horizon there. Well, as always, you did a great job, Rachel, of covering those headline topics, I like to call them. So we don't have any additional questions at this time. As you know, I think people are just feeling the uncertainty, and so it's a little bit of a we're waiting, wait and see, which
Mhm.
is just an uncomfortable space, I think, for us to live in. Whether it's our investments or other aspects of life, it just feels like if something's going to happen, we're ready for it to happen. So I know that you'll continue to keep us updated as the world changes and the markets and economy evolve. But for now, we'll thank you for your
You-
information that you shared, the thoughts of CNR, and oh, of course, I have one question that's popping in right as we're. Oh, it's a thank you. So yes, the
You're
group also
welcome.
says yes, says thank you for everything. So I hope everyone has a wonderful afternoon. Rachel said it's 70 degrees in San Francisco, so I hope that you can get out there and enjoy some of that warmth and sunshine.
Thanks so much, and thanks for having me. Always a pleasure.
Have a good one. Bye.
Bye.